The Reserve Bank's Monetary Policy Committee meets in the background of challenging global cues, with US yields and crude oil surging. Now, as always, Citizen Monetary Policy Committee of CNBC-TV18 meets ahead of the Reserve Bank's MPC to deliberate on issues confronting the policymakers. I have with me my members, Chairman of our committee, Dr. Pronab Sen, and the members, Sajjid Chinoy of JPM, Samiran Chakrabarty of Citibank, Soumyo Ghosh of State Bank of India, and Sonal Varma of Nomura. Gentlemen and Sonal, thank you very much for your time. Okay, since I started with the global backdrop, let me make that the first question. Sajjid, that's to you. Jamie Dimon has famously just said, are we prepared for 7% US yields? Now, US yields have already climbed rapidly in the last few weeks. Can you parse the global environment that the MPC is confronted with?
I think, Latha, the global environment has become much more challenging compared to when the MPC last met 2 months ago. Some of the genesis of this is just the sheer strength and resilience of the US economy. Remember, everyone was expecting some kind of slowing of the US economy in the second half of this year. Guess what? The third quarter GDP is tracking 3.5%, much above the 2% that we've seen in the first half of the year. So this is now beyond resilience. This is full-blown strength. And this is what's going to keep the Fed nervous and cautious, that even though there has been some disinflation, core disinflation in recent months, you can never be sure that this is going to endure, given the strength of the US economy. And that's why the Fed has very modest rate cuts in 2024 and 25. And once the market has come to figure that out, rates have gone up and we're in this high for long environment, which is why the US 10-year yield is close to 4.5%. But that's only one of the trifecta. The second element is US exceptionalism, that you've got US strength, which is juxtaposed with European growth stalling. Europe this year will grow at less than 1%. And that has meant that the dollar continues to strengthen and is at a 6-month high at the moment. And the third element is, as if this combination of higher for longer US rates and a stronger dollar is not enough, you've got OPEC cutting supply, so crude prices are above 90. So this is a more challenging global environment characterized by higher rates, a stronger dollar, higher crude prices. It's a mini rerun of what happened in 2022. Not of the same magnitude, but directionally the same. And therefore, emerging markets in general will have to double down again on macroeconomic stability.
Okay, got that. Soumyo, that's the global scenario. Looks a little inflationary compared to what perhaps the MPC was prepared for. Do you want to add anything to that? But more importantly, our inflation trajectory, August was clearly lower than what the market was prepared for. Is there even a chance that Reserve Bank will lower the CPI projection from the current 5.4?
Thank you, Latha. I think regarding the first point, I don't think the Reserve Bank is going to lower the CPI inflation yet, because it needs to keep the pedal firmly on inflation control, as it has been saying, and I don't see any change in the communication or stance in the policy. Now, the important point to know, even though the September inflation number could actually come significantly lower because of base effects and other things. But regarding your first point on the global economy, I think we are actually currently in interesting times. The JP Morgan has recently added India, is going to add India to the bond index. So actually everything opens up a Pandora's box. If I just jog our memory 30 years back, in March 1990, in September 2000, in October 2007, the Fed actually had made changes and the economy was very strong. And look what happened after that. My simple conjecture is that the economy may be very strong, as you correctly pointed the US economy, but a scenario of a soft landing as of today, or a hard landing, or many words are being thrown, or a recession, I think this is very difficult to judge at this point of view. The most important point is that we are living in an era of uncertainty, so we don't know what is going to happen next. But one simple data point which could actually make the thing a little more make the things look a little more difficult for the global economy is that I think a lot of these if Fed is unlikely to cut rates very aggressively in 2020, what it has clearly said, that means that it will be higher for longer. That means the reset of these loans, which these people have taken at fixed rates, that is unlikely to happen in 2024-25. If that doesn't happen, that will add to significant trillions of debt to the household, and that will continue. So in my sense, the jury is still out whether the economy is stronger, or it will be a soft landing, or it will be something else, maybe 1 or 2 years down the line.
Oh, yes, the new word seems to be even no landing, that we go on with the confusion. But yeah, Soumyo, you are raising some red flags on growth. Not very fashionable when the US growth is so strong. But let me toss that to Sonal. Sonal, you have always worried that India's growth will falter, but numbers are still decent when you look at the last GDP number, or the tax collections, or the power consumption, or auto sales. What's your sense? Does the Reserve Bank have to tinker with the growth number of 6.5 at all? They may even give us a forecast for next year. What is the growth scenario that MPC is confronted with?
Yeah, Latha, I think as is the case in US, I think India as well, the domestic demand side in particular has been more resilient than expected, at least on our end. I think the RBI is likely to retain its 6.5% growth projection for this year, and they might in fact pencil in a similar number of around 6.5% even for FY25. The Q1 numbers at 7.8 were largely in line with the nowcasting, and the momentum in the second quarter currently is showing a higher momentum, even though the YOY will come down. So from the RBI's perspective, the view on strength in domestic demand will likely remain the baseline. I would, though, question the sustainability of the growth outlook. I think one, I would say the distribution of rains and its impact on food production does question the extent of strength one should be building in on both agriculture on the supply side and rural consumption on the demand side. Second, I think public capex, we've seen significant front loading of public capex, and that has been a big growth contributor. I think going forward, particularly after December, our view is there will be some scaling back on the capex numbers. And third, I think in terms of private investment, our view is it is not yet broad-based. And in light of the global uncertainty and elections lined up here in India, we don't think there's going to be a material takeoff yet. So I think things do look good, but in terms of their sustainability into next calendar year and FY25, to our mind, is still questionable.
Mm-hmm. Well, if growth is as good, then perhaps the excuse to cut is also moving away. Of course, there are other reasons why they cannot. Samiran, the bond index has already been referred to. I wanted to know whether that is material at all for the MPC in any way. And more importantly, how should they behave when you are confronted with this kind of a global environment where rates are so high?
So, Latha, the actual flows on this bond index are going to not so much be a factor in FY24. It's more a FY25 issue. At best, some active flows can come in end of FY24. But the bigger thing from a monetary policy perspective to think about is that whether this is going to now make our monetary policy more connected with the rest of the world. Earlier, we could easily follow an independent monetary policy because the total investment into Indian government bonds was just 1.5%. And similarly, on fiscal side, now there would be more market discipline on the fiscal behavior. So both these things from a macro stability perspective are good, but they will put some shackles around how fiscal and monetary policy can be governed. On top of it, the big challenge would be that because this will be a one-time inflow, how to manage the liquidity considerations coming out of this. At that point of time, how much sterilization would be needed? between the different instruments of sterilization, OMO sales, MSS bond issuance, CRR, or FX swaps, which one would be preferred, which will have least unintended consequences on markets. I think we'll have to grapple with all these issues when it comes. The immediate objective should be to reduce volatility in rates and FX at the time of these flows, because we all understand that this is a one-time phenomenon. Once the index weight of 10% is reached, incrementally every year, the amount of flows will be minimal. So from that perspective, if we can manage this period well, then it's a good thing to have.
You know what I'm taking away from what you said? That we have to be more responsible. As you say, both for the fisc and for RBI, there is a big tail that can wag the dog, so to speak. So, you can't take liberties with the fisc. So that is the question to you, Dr. Sen. We have an election round the corner, and, typically you could see revenue expenditure go up. And after all, fuel and food is an issue. So even without an election, there could have to be higher revenue expenditure. Do you think the MPC and the RBI have to keep that behind their head? In their process of achieving that 4%, will the fisc become a problem? Is that a factor?
Almost certainly. Look, at the moment, I think we should have our eyes firmly trained on the elections and the build up to the elections. And it's not just a question of, how the fisc behaves. Whether there's going to be more revenue expenditure. There may not be, but there may be a lot of announcements which could have very, very strong expectationary effects. So, but the other thing we have to keep in mind that Indian elections have always been preceded by a huge amount of private spending by the political party. So there is an unnatural boost to demand that happens in roughly 4 months prior to the elections. We are just about coming into that window now. Another month and we'll be there. And that's something the RBI has to keep in mind, because that is going to happen. Which means, and remember, RBI is going to be in a purely reactive situation there. Yes. So they have to figure out what the likely implications are, given what the global developments have been, and how do you best adjust to it? Do you need to take proactive steps, or do you wait until it starts happening and then try and pick up the pieces as you go along? This is not an easy call. And if now we have a situation where there is a sudden influx of external funds into the bond market, that just makes RBI's job that much tougher.
Okay, I thought this was just a more of the same policy, but actually quite a few problems, isn't it? Crude unnaturally high, or higher than what it was when they previously met. US yields higher, more money likely to come and create a liquidity problem, and fisc could be a problem. So will the liquidity tool be used much more by the RBI? That question to my guests after this break. Welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC-TV18. I've been speaking with the chairman of our MPC, Dr. Pronab Sen, and members Soumyo, Kanti, Ghosh, Samiran Chakrabarty, Sonal, Varma, and Sajjid Chinoy. Gentlemen, and Sonal, thank you for your patience. Well, Samiran, I want to come to the liquidity question. But before that, we haven't discussed inflation enough. There is a crude element. Does it change the calculation a lot? As well, monsoons here, there, not there, reservoir levels. Just tell us if the inflation number of 5.4 and the trajectory will undergo some change.
So this is one area where there is good news and there is bad news. So the good news is that the vegetable prices have corrected maybe much faster than any one of us would have anticipated. The good news also is that core inflation momentum is running pretty low right now. But the bad news is that, one, as you mentioned, crude has gone up, although it might not have an immediate impact on the inflation numbers because the retail prices of petrol, diesel have been kept constant. But if you look at the food basket, there are other areas like pulses, rice, and I fear about the impact of global El Nino on edible oil prices, palm oil, etc. These are still concerned. I mean, pulses are still growing even for the month of September. Rice is also leading. So in some sense, this will not let the MPC relax on inflation. Our sense is that while the September print will be probably 5.3 kind of a number, but as we move to the back end of the year, December, it can again cross 6%, and then in the Jan-March quarter come down to 5.2%. So RBI will not be in a terrible hurry to revise that 5.4 number, but there could be some marginal changes to that as well.
Upside risk.
There is an upside risk on that as well. The critical thing would be that RBI will now be forecasting for end FY25. Now, where that number comes out to be, would they be comfortable giving a number closer to 4, or would that remain still pretty elusive in the forecasting horizon? I think that will determine the whole real policy rate discussion, and to that extent, the expectation about the first rate cut will have to be adjusted as well.
Oh, yeah. You're right. This is September policy. Mid-year policy, you also get their MPR, the Monetary Policy Report, which will give us many more forecasts of how RBI is looking at FY25. And a couple of the forecasts will come into the statement itself. But now for the big liquidity question, because in the past two policies, the Reserve Bank has made it very clear that they won't tinker with rates, but they are going after inflation through the liquidity channel. So, Sajjid, what is your sense? Liquidity takes a front seat, takes the center stage. Do you expect RBI to continue to keep liquidity tight? That is, keep the call rate closer to 6.75 than 6.5?
I think given what's happened, given the inflation risks that have arisen from monsoon and crude, I think the RBI will want to prefer a status quo in ensuring that overnight call rates, remain where they are and don't come down very much. Liquidity management is going to be a little bit tricky because in the next couple of months, there will be occasions in which liquidity, headline liquidity will go into a surplus in early October and early November. So the task before the RBI is to ensure that, liquidity doesn't do that, and you sterilize enough in different mechanisms temporarily so that the weighted average call rates remain where they are today. This is something that, in fact, all Asian central banks are doing in different ways against the backdrop of a stronger US dollar.
Sonal, how worried are you about liquidity, or rather, how much do you think RBI will worry? Is there any CRR hike-like instrument that we should put on the table?
I think there are various options, obviously, Latha, on the table, some harsh, some not so harsh. I think clearly, as Sajjid was mentioning, the risk to inflation from the supply side factors are still there. And in that scenario, RBI would want liquidity to not go into a big surplus. But at the same time, they would not want it to be too tight because they do want credit for the productive sectors to basically continue going forward. And I think there's uncertainty on how the dollar inflows will be, and therefore whether it will be a source of liquidity or actually could be another tool to drain liquidity going forward. So we don't know how that goes, but we do know that there's going to be more currency leakage because of different factors, festive season, elections, etc. So I think in that scenario, it would probably be best for the RBI to not use very harsh tools at this stage. So if there is an opportunity to sell dollar and absorb liquidity or even do OMO sales as necessary, or of course the VRRR option could be used. A harsh measure like a CRR is obviously an option which probably will get discussed. But in terms of actual implementation, I think right now one thing, as Samiran was mentioning, core momentum has surprised on the downside. So the supply side inflation risks at this stage are not materializing. So I think keeping liquidity just a bit in surplus, so keeping the call rates in the 6.5, 675 zone and managing liquidity through some of the non-harsh measures would probably be the right approach at this stage.
Okay, fair point. Yeah, the liquidity stance can be expressed through the call rate. Soumyo, very quickly, what should we watch out for in the policy? Some wording, some phrase. What will you all ears be?
See, Latha, I think in terms of the policy wording, I think it will remain like it is, because it will say that the Reserve Bank will continue to be watchful, and given the fact that inflation, even though is going to trend down, we need to understand that headline inflation is unlikely to come below 5% throughout the rest of the current fiscal, and possibly it could reach a peak in December. So even if you look at the inflation trajectory, yes, within the RBI band, but not below 5%. So from that point of view, the RBI will continue to be watchful. The food inflation possibly may not flare up again, given the fact that it has corrected too much, and the fact that the core inflation, which sometime back was looking the most sticky part, is now looking the more flexible part of the downward trajectory. That will make the RBI comfortable.
Yeah, actually, core inflation has fallen everywhere. It's not just to our credit. Looks like China is a big disinflationary force, and that's helping everyone. But Dr. Sen, last word from you. What should be the message that RBI should give in its stance and in its wording around the stance?
Well, in terms of its wording, since you brought up the issue of liquidity, I think the RBI needs to worry a little bit about the feeling that I think a lot of people have, that liquidity already is in deficit. And I don't think they should continue to nurture that impression and make it worse. But as I said, they have to bear in mind the demands that are going to be placed on them prior to the elections.
Okay.
And if RBI thinks it's entirely independent in terms of what decisions it takes, it isn't. So you're going to have a game plan that is under evolution at the moment, and the RBI needs to keep, whatever instruments it has on hold for the moment, waiting for it to happen. But this is, given what has been happening at the moment, I wouldn't tinker around with the liquidity very much at this stage.
Okay, that's an important point of view, sir, because liquidity, as even Sonal pointed out, could go out on its own ahead of Diwali or during Diwali, normal time when Indians pull out liquidity from the banks. Okay, you said on hold. That gives me the clue to ask you to vote. So first, shall we start with the first voting question? What do you think Reserve Bank will do to rates? Start with Sajjid.
It will be a hold, a pause.
Hold. Okay, Sonal?
A hold.
Okay. Soumyo, yours?
It will be a hold.
Samiran?
Same, hold.
Chairman?
Hold.
Hold. Okay. This is a unanimous vote. And the next question, I'm suspecting, is not going to be all that unanimous. The stance currently at withdrawal of accommodation, will they change? If yes, to what? Sajjid?
I think they'll retain the stance, withdrawal of accommodation.
Okay. Sonal?
Retain stance.
Okay. Soumyo?
Retain the stance.
Samiran?
Retain the stance.
Okay. Dr. Sen, your members say retain.
They're unanimous, but I tend to disagree. I think that may send just the wrong message.
Okay.
They should actually move to neutral and give the impression that they're ready to move in either direction.
Okay, I mean, that would be very big if they did, and that would also perhaps put the government on notice in case something fiscally ugly comes. But let us see what the Reserve Bank and the Reserve Bank's MPC does. Thank you very much, members of the Citizens MPC.